sesh on financial objectives. So when we're thinking about financial objectives, we know that's a type of functional objective or departmental objective, and that is going to be driven by the overarching corporate objective. Now, the four most basic types of financial objectives that if you did GCSE business will be very much aware of are the following. So a financial objective could be a profit focus. It could be as simple as just to be profitable. Or it could be to maximise profit, what you think is the potential that your business could make in profit and try and make that, maximise that. It could be, instead of a profit focus, it could be a revenue focus. It could be to maximise your revenue. Maybe it's because you have a market share focus. You're trying to make as many sales as possible in the short term to build that market share. So in the long term, you could ideally become profitable, but it's a two-step approach. Or it could be that you're looking to focus not on your revenues, but on your costs and keeping your costs down. You might want to minimise those costs, whether they're fixed costs or variable costs. Or it could be that you want to focus on your cash flow. And it might be that you have a cash flow focus because you want to increase your liquidity, particularly because of the recent health crisis that's turned into an economic crisis. We can see that many businesses would ideally have quite high quick ratios right now, which is to suggest that they have lots of cash so they can see through any periods of great uncertainty that potentially are on the horizon. Now, beyond those four types of financial objectives, there are two that you must be aware of for A-level. The first is return on investment. Return on investment is sometimes shortened to ROI. And you might want to have a specific ROI that you're aiming for. That would be a specific percentage. Now, the formula for return on investment is return from investment. Remember, return from investment means the difference between the gain, profit from the investment minus the cost of that investment. So return from investment divided by cost of investment times by 100 because it's expressed as a percentage. Now, if this pops out, the formula, and it comes out as a negative number, it's not a good thing. If it comes out as a positive number, and the higher the positive number, that's a good thing because it highlights the fact that you have had strong capital management. It's a sign that you've been efficient with your capital. You've been efficient in terms of the investment versus what the investment has generated as a percentage of that initial investment. So it's a sign of efficiency within your investment, which is why it's sometimes seen as being better than your GPM, being your gross profit margin or your operating profit margin or your profit for the year margin or net profit margin. It seems being better than that because that's just a crude measure comparing the particular profit against the revenues. It's not looking at the efficiency in managing that capital. Other things to think about is that it's useful for a comparison. It could be a comparison internal within your business. You might have 2 projects or more projects and you want to look at the ROI for each of those projects. Therefore, the one that you choose would ideally be the one where you've been the most efficient within using your capital. Other things to think about with ROI is that, well, it doesn't adjust for time because it's not very specific. It just says return from investment. It doesn't say when it's being returned. So you might want to double down on that and look at your ARR. More details on that, click the card up there. But if you look at your ARR, it will allow to put this in a form of an annual basis rather than just a return on investment in the generic basis. Other things to think about, it doesn't have any account for any qualitative factors. It could be the fact you've done a marketing campaign or there's been some sort of change within the economy that may muddy the actual numbers that come up, so you can't really interpret it. Now, we're talking about financial objectives within this, and when we talk about return on investment, it's critical to be aware that you might have the objective to have a certain return on investment. It could be the certain return on investment you're aiming for is 20%. And if the project meets 20% when you try and project what it might generate, well, then that might be the reason why you go for that particular project. So you might have a set number that you're aiming for. If that's the case, it's sometimes referred to as a hurdle. Now, the final type of financial objectives that you really need to be aware of is number 6, which is looking at a percentage of your long-term funding, be your capital, versus your debt. Because businesses will have a capital structure. A capital structure is essentially just a breakdown between your debt capital, so your capital through debt, and your equity capital, so your capital from equity. Examples of debt capital: loans, debentures, bonds. Examples of equity capital: share capital, when you issue shares to become a company, and retained profits, being the historical profits that you've kept over time. Now, you might want to compare the amount of debt capital versus your equity capital, or compare your debt capital overall to your capital structure, just being your debt and equity capital added together. Now let's just say that you have £9 million worth of debt capital in your business through loans, debentures, bonds. That's how you finance some part of your capital structure. And on the other side, you've got £1 million worth of equity capital through issuing shares, perhaps, or it could be retained profits. Now, in this case, clearly 90% of your capital structure is made up of debt capital. Well, that could be a concern because it's too heavily funded on debt. Risks here. One, well, if interest rates were to increase, well, that's going to put extra pressure on those loans, those debentures, those bonds, if they're on a variable format. Other things to think about is that if you are a company, it might be the fact that creditors are aware through Companies House. The fact that you have such a strong debt capital could make them concerned or wary of giving you too much leeway in terms of those creditors. Other things to think about is when we're thinking about interest rates, well, there has been a real trend towards debt capital in recent years, particularly since 2000, 2008, 2009, when we saw interest rates really come down, the central bank interest rate that is, which obviously fed into the wider economy. And we've seen this trend towards debt capital because interest rates have been so low now for a period of just over a decade. Other things to think about is in terms of particular industries, well, different industries will have different likelihoods of their capital structure breakdown in terms of debt and equity. Probably if you've got industries that have got expensive fixed capital that they have to buy, maybe mining or agriculture, industries that could be, for example, extracting oil, those types of companies will likely have lots of expenditure on fixed assets. So for that reason, it might be the fact they have slightly heavier debt capital weighting. So that's something to consider when you're thinking about what is the ideal amount. It depends on the particular industry. Anyway, I hope that helps on financial objectives. See you next session.